Hello and welcome to another video on reporting and analyzing liabilities. In the previous video, we had talked about current liabilities. Now our focus is going to be on bonds payable, which is a long-term liability. So let's look at some of the major characteristics of bonds. Bonds are basically interest-bearing notes payable. So what is different between bonds payable and notes payable? They're usually issued by corporations, universities, and government agencies. So when businesses or the other two that are mentioned over here, universities and government agencies, need a very large sum of money, instead of going to a bank and borrowing from one single party, they issue bonds. So these bonds are sold. Issue is also another word for selling. They sell small denomination bonds, usually $1,000 or multiples of $1,000. That's the face value of the bonds. So when a corporation issues or sells, they are borrowing money. The person who buys the bonds becomes a bondholder. They are investing in the bonds. All the accounting we are going to do in this chapter is from the viewpoint of the company that is selling the bonds. So let's look at some of the characteristics of bonds based on how secure or unsecure the lender feels. So the lender is the one who is giving money, the bondholder. They want to invest in the company. However, if they're not very comfortable with your company, the finances of your company, they would prefer that you issue secured bonds. So here what we're looking at is these bonds are issued against specific assets. These assets have been pledged as collateral for the bonds. So once again, think in terms of what are bonds? Bonds are liabilities. In the event a company goes under, they sell all their assets, they use it to pay their liabilities, and then they will pay the stockholders' equity. If a company is getting to the point of selling all their assets, the equity holders are not going to get anything. It's just, you're looking at the creditors, the liabilities, and even there's not going to be sufficient money. So then the question is, who gets money first? Who has a higher claim on the assets? If the bonds are secured against specific assets, those assets, when they're liquidated, that is sold and converted to cash, it will be used to pay the bonds, the secured bonds. Typically, this is issued by companies or governments that are not in financially a good position to borrow. So basically, think of someone with very poor credit. When you go to borrow money, they're going to ask you for a collateral. That's exactly what we're looking at over here. Now, most cases, when we look at bonds being issued, they're unsecured. That means these are issued against the general credit of the borrower. In the event of liquidation, a bondholder has no higher claim than anyone else. So once again, if the problem mentions you may have secured bonds, otherwise you're looking at unsecured bonds. Now, when the bond is due, all liabilities become due at some point of time. These are long-term liabilities. When they become due, you typically pay cash. Now, it could be that the terms that we have specified are they are convertible. So what would they convert into? Convertible bonds convert into stock. So the investors have agreed when they loan me money that on due date, instead of giving cash back to them, I'll give them stocks in the company. So this is a feature that is sometimes attractive for some investors. They may not be confident in investing in my stocks right now, but in the future, they think I'm going to do well. It could also be a case that when they invest money, with bonds, they're going to get interest. With stocks, they get dividends. Right now, the company may not be paying dividends. So they want to get the interest right now. And if they think in the future, things are going to change for my company, they obviously believe in it, they'd rather have common stock in the company at that point of time. Now, I told you that all bonds are going to mature and you have to repay the money. You being the corporation, we're talking from the viewpoint of the company. So let's say, for instance, I have issued 10-year bonds. I've sold 10-year bonds. I borrowed money and I've said 10 years from now, I'm going to repay the money. I've agreed to an interest rate right now. That's called the bond interest rate or the stated interest rate. What if my circumstances change and I can now get a loan for a much, much favorable interest rate? Why should I stick with that old interest rate? Or maybe I'm just in a position that I can repay that money. I no longer need to keep that debt in my books. Now, if I have a call feature, then I can retire the bonds sooner than 10 years. So callable bonds can be redeemed, that's bought back, by the issuing companies at a stated dollar amount prior to maturity. Once again, at the time of issue, the seller will have all of these printed. These terms and conditions are all written out. So the buyer is made aware of it before they make the purchase. No surprises. Continuing on with some terminology that you would find in a bond certificate. This is issued to the investor. It's basically a document. It provides the name of the company, the face value of the bond. It's typically $1,000. The maturity date, the date on which the principal has to be repaid, the contractual or the stated bond interest rate. These are all the terms and conditions that the seller and the buyer are agreeing to. The seller is the company that's borrowing money. The buyer is the investor who's loaning me the money. The face value, this is an important piece of information that we need to take to start working on exercises. Is face value. What's the principal amount that will be repaid at maturity? That may not necessarily be the amount of money I get right now, but that's the face value is something that's important we'll take a look at. Maturity date is when the entire principal has to be repaid. Interest will be paid periodically, but the final payment, when it's due, that's the maturity date. Contractual interest rate, unless mentioned otherwise, it's always an annual interest rate. That's used to determine how much interest I need to pay in cash every year on a predetermined date. And how do bonds trade? The bondholder, the investor, can sell their bonds at any point of time in the National Securities Exchange. So when the company sells the bonds, they borrow money. As an example, I'm the company, I borrowed money, let's say it's $1 million, and I said I will return it 10 years from now. Those bondholders, they don't have to hang on to those bonds for 10 years. They could sell it in the open market. That's in the Securities Exchange, they could sell it. The prices are quoted as a percentage of face value. So the face value is 100%, and then it'll be quoted as a percentage of that number. So if it is 98, it means 98% of face value. If it's 103, it's 103% of face value. Corporations will make journal entries only when they issue bonds, when they pay back the bonds, or when they're paying interest. When they're paying back the bonds, they may convert it as common stock. That may happen, as I said earlier, if they're convertible bonds. That's the only time they're going to do journal entries in their books. The bond holder can buy and sell those bonds 1 million times over in the 10 years. The company is not going to do any journal entries. They just need to keep a record of who the bondholder is so that they know who to pay the interest to. Beyond that, they're not going to do any journal entries. So what are some of the factors that affect the bond issue price? If you recall a few minutes earlier, I said the amount of money that's going to be repaid, that principal amount may not be what I get right now. So let's take a look at what are the factors that could affect the bond issue price. At the time the company is issuing the bonds, the market value, the market rates may be different. And that is going to cause my bond issue price to be higher than or lower than the face value. So dollar amount to be received, length of time, and the market interest rate. So how much I want to borrow, how long I want to borrow it for, and the market interest rate at the time of issue. Not subsequently, at the time of issue, because I'm looking at the bond issue price. These are all going to be static numbers. I'll use this information to calculate the bond issue price by calculating the present value of cash flows. The process of finding the present value is referred to as discounting the future amounts. So the future cash outflow for the company, there are two future cash outflows. One is the principal itself at the end of the life of the bonds. That's a one-time payment. So when you have to do the present value calculation, it's present value of a single sum. The interest payments are annual. It's a series of cash flows. So that's going to be discounted as present value of an ordinary annuity. Those two numbers put together, present values put together, will give you the bond issue price. So in the next video, we're going to work on an exercise in which we look at bonds issued at face value, above face value, below face value, the journal entries we do when we pay interest, and also we look at redemption of bonds. So that's going to be in the next video.